Hi, Warriors. How's everyone doing? Back in the chair. How are you, Glenn? Ingmar? Everyone doing okay? Hope everyone had a good week. Bran, thank you. Shahab, Kman, how are you? Blake, good to be back in the saddle with the ForexAnalytix team. Ryan, AJ, Patrick. Okay. Thank you very much, George. I hope everyone had a good week. And if you're having some difficulty, I want you to listen to this. Okay. A good coach can change a game or the game. A great coach can change a life. And we have 5, at least, great coaches right here for you guys to talk to and to clean up and take a look at what you're doing. So check out our coaching program. Okay. There's nothing wrong with trying to get better by learning from someone who's already there. You can't learn experience because it only happens with the passing of time and living through things, but you can learn from the experience. So consider that. Okay, so team, how's everyone doing? I want to start off with,
Coach.
yeah, I'm back.
Welcome back, Dale.
Thanks, Kay. It was a great trip. And Blake said I should go or I'd regret it. So another great call by Blake. All right. So
Glad
since
you
I was,
glad you did it, man.
yeah, one of the best weeks of my life, actually, it turned out to be. So the dollar made it up towards this 102 level. I don't know if it's over. This looks pretty impulsive. I wouldn't chase it here, but a lot of things got to targets. Yen almost got up to, 150. 49 is pretty close. The 10-year yield, I was talking 4%. We're over that now. And metals have mainly moved sideways. But if silver takes out 31 here, I still think you could see one more trip down. And gold's moved pretty sideways. I mean, really sideways, a lot of sideways action. Yeah, it could still make a new high. They're turning the gold silver ratio. S&Ps, there were a couple bad days as things continue to escalate in the Middle East. That's not going away anytime soon either. And God, guys, we're less than a month away from the most consequential election in American history. So a lot of things happening. I see that crude made a move, pretty nice move, never made a new low here. I wouldn't chase it, but I'd buy breaks, maybe back towards 73. Looks like they're, trying to turn the trend here. This looks pretty impulsive. If Grega's here, maybe he could take a look at WTI. All right, well, maybe you could, you have a comment on WTI before I go to the rest of the team, Grega?
Well, we have this free wave rise from that low, so it's a key resistance up there around $78. But I think that crude oil should be more important this week because of inflation data. Crude oil was up, has bottomed actually in September. So I'm just wondering that if inflation will miss the expectations of 2.3%, and with already strong US dollar, that we can have actually much more upside on the US currency.
Okay, and WTI?
I think it will stay in range.
Okay.
Here, you can see that yourself as well, that we are back in that triangle that you've been also tracking. So I think that this triangle will now just resume. I would not have any strong convictions here at these levels. I just think that it can be a very bumpy around.
Okay, yeah, so they took out the bulls, and if we get back over 80, they'll take out the bears. So,
yeah, I think that 80 is also very important resistance. Maybe if we get another push higher, it goes back to August highs when we had a lot of risk-off environment. So I'm thinking that from a time perspective, that levels up there are very important.
Okay, and before I left, Grega, you were here. You were calling this a wedge down here. It's exactly what it was. You know, never even took out par. And then you had a count that if we get through 103, the actually 106 would be doable. So
Um,
are you still there?
Actually, that's first leg of recovery, right?
Yeah.
So it can be wave A, can be wave one. Okay, but
Okay.
I always try to analyze markets step by step, not going too
Right.
far into the future. So I will not call any new bullish, very strong impulse in 5 waves. I will try to stick with minimum expectations, meaning I will look for at least 3 waves up. So my projection would be around to 104, which is also the 61.8%. So after some potential setback that could unfold already this
Yeah.
week, I would be looking for more upside towards 104.
Like an
So
ABC. And
yes, exactly.
that be like the 200-day as well up there?
Yeah, I can see that, right?
Yeah.
Yeah.
So okay. Thank you, Grega. Good to hear your voice. Let's
Thanks.
bring in Ryan, and we'll get back to you. I'm sure Blake will. So Ryan, but when I left, you know, it kept trying, it couldn't do it. Where's your head at on Euro USD right now?
Yeah, morning, Dale. Welcome back,
Hey,
mate.
buddy. Thank you, buddy.
You've been sorely missed. But Blake did
Uh,
try singing, but while you were off, it was like someone feeding a cat in a mangle. So that didn't go down too well. But so we welcome your voice back as well. Yeah, the euro. I had the level here down at 109.60. It dipped under
yeah,
to 50, but it's holding. You can just see we've had prior highs around this 40, 50 area, 60 area. Yeah, it's taken a bit of a knock. Obviously, a lot of it is to do with last week's non-farm payrolls, which was
yeah.
gangbusters, and the market getting all hawky, well, undovish over
Undovish.
bed.
Yeah.
Yeah,
So
and
what
we're
did
still,
dot plots change dramatically after that number? And were people saying, "What's Powell doing?" You know, he did that big half a point cut,
yeah,
and then you get a strong jobs number. Um,
exactly.
he's gonna have some things to answer for unless they revise it, last week's number,
Yeah,
which
exactly. Yeah, everyone keeps saying, why did they cut 50
yeah,
if we're getting numbers like this? But you can't just go off one data point. The economy has been weakening. We thought it was going to be a bit of an insurance cut going to 50 just to get the ball rolling, and he said they're going to be doing 2 more and 25s, and the market's set with that. But yeah, so we've seen the euro dollar getting a knock. It's had a little go to try and get through 110. It couldn't. That's the
yeah,
main level. That was
okay,
decent support when we were ping ponging between there and 112. If it holds below there, then maybe further downside beckons. But if we get above 110.15 is my number, then we could be on for pushing back up and staying in the range. But we're holding the fibs. We're holding the fib of that August move, holding the fib of that April move, and it keeps the trend in play.
okay. So EG is trying to bottom. Your comments on cable pretty much the same, although cable hasn't challenged as low like Euro has.
Yeah.
Is this year still, if you want to be short the dollars, cable still a preferred long for you?
Not at the moment, because Bailey gave it a kick in the pants last week, coming out with some dovish comments. Saying they may be a bit more aggressive with cuts and a bit more activist on cuts. So that's what did the damage for cable. But it was pushing in an open door, because obviously we then had the NFP afterwards. So it's 2 winds blowing it that way. The pound might be finding a bit of balance now. It was the exception trade, but we've got the upcoming budget to think about, and then this shift from Bailey. So it's making it a bit messy versus the dollar. But like you showed on Euro Sterling, it's a bit clearer there, because we've seen the pound weakening a bit more so there. So yeah, I wouldn't be in a rush to buy cable. Maybe that 130 is a decent level. But yeah, might not
So
be
we
in a
had,
rush to be too long the quid.
okay, and Aussie negated the breakout.
all
This
China.
probably all China. So did China stocks pull back while this was happening, or what?
Well, they were on holiday all week. They opened up today. They bulldozed the opening, went up like 11% Chinese stocks, but then the market was waiting for some comments from their state officials and various agencies about further economic boosting measures. None came, so we've had a little bit of a washout there. Again, in this one, a lot of the NFP and dollar side behind it. But if you look at something like copper, you'll see what's happened with China not putting out any more bazookas today, and that's probably a cleanest, apart from Chinese stocks, that's probably a cleanest hopium trade in terms of what this China stimulus means in terms of how the market's viewing it, and it needs to see some action now for all the kitchen sinks that's been lobbed at it.
Yeah, better hold 420, or this is just a bear market rally.
Yeah, and then your Aussie's going to follow, of course, and the rest of your commodity currencies.
Okay, let me bring in Kman.
Good morning, Dale. Welcome back.
Kman, buddy. Thank you so much, man. So, has this been enough in the end? Are we going to end up trying? Yeah. Are we going to?
Well, there's a lot going on geopolitical side. Interestingly enough, is that when we were trading up at 149 during Tokyo time, the officials already came out saying about the one-sided moves and things. But the interesting one today, post NFP, is that we held the prior highs, and we held them, and we are bouncing. I'm pretty. I'm a bit annoyed because I missed my entry for exactly 1 pip this morning.
I hate that.
33. The low is 34, so I'm a bit annoyed there. But no, I think it's actually holding where it had to hold for this move at least. And so I personally think that unless we get a weak, if we get a weak CPI on Thursday, the expectations for rates and stuff will shift again. We know how this yo-yo is going on, and this pendulum swing is ongoing. And then the market will already have forgotten about the NFP or the unemployment rate, and then it could go lower again if the inflation data miss. But no, I actually think it's still all in all relatively
51 was, and we all know 52 is so important.
I'm reluctant to call 52, but I want to see if they really come out of the woods, and not interventions also, but if they're going to up the rhetoric if we test 150. So I'd at least would love to see a test of 150. But of course, I mean, data will depend more so US data than the Japanese data, because we have seen now, for instance, with the US yields coming up, dollar yen is not reaching those fresh highs, but there's been a lot going on in China, geopolitics and whatever. So I think we're in for a bit of a yo-yo, but I'd say hold low 147s. We could still be in for a test of 150. That's my view. And to come back on the sterling, I think sterling is going to be a bit more two-way, but the mood seems to be changing a little bit. And as Ryan already said, Bailey, for one, changed the mood a little bit. But also, I think we're 3 weeks away from the budget, and insurers are starting to be a bit nervous. I don't know. I think sterling maybe, when the mood changes in sterling, it can do a bit of damage. And I'm rather going to perhaps look to sell sterling rallies than to buy sterling dips right now, personally.
Okay. Thanks so much. Great to hear all of your voices. So, I'm going to bring in Blake for the Looney, because this was a pretty nice move. Blake, more upside here in USD CAD?
I think so. It's due. Well, it's a couple of things. As you guys were just talking about the inflation data, first and foremost, you know, we have US CPI, but more importantly, I think is the Canadian jobs data on Friday. I personally didn't think we'd be up here so early in the week. On the week ahead video, I talked about, you know, I do feel that we're eventually going to 140. I didn't think we'd be testing these levels right now. But if you guys don't remember, the 136.10 level is really big. We surged past it yesterday, and we're holding today. And you know, I'm more scared because I'm not in it. I'm more scared it's going to just start running without me, you know? So that's always the fear. But, you know, without a catalyst to be buying it other than, you know, just dollar shorts getting squeezed, which is not necessarily a bad play either, but it's not something that I have any impetus to be, you know, just buying it just to be buying it. But it does feel like it wants to squeeze higher. And I guess what's really going to help it is if crude oil comes off. I know you guys were just talking about crude, but crude's had a hell of a squeeze higher to the 618 retracement. And so if crude starts to back away from these levels, and the 200-day DMA, by the way, if crude starts to back away, maybe that will be one of the things that drives the dollar CAD higher. I don't know. It's a hard call, but maybe a little bit of this move is off the China slide that we saw overnight too. So
okay. And I wanted to, you know, ask you how you feel about risk. I know we've had a couple down days. I thought that we'd go to 56. It didn't even get close.
The 5680 level still holds. I mean, you know, even yesterday's brief dip below 5700, it's holding. I mean,
it's a beach ball, isn't it? Still,
it is. It's a beach ball. It's a managed market. There's nothing derailing it. You can't you know, I thought maybe the China sell-off overnight was gonna, you know, give us a little bit of you know, some risk aversion. I thought that might be the case. It's not. The DAX is still holding up pretty well. You know, the DAX is holding where it needs to hold. The S&P is holding where it needs to hold. You know, repricing, rate cuts didn't change the market while you were gone. I thought that could be a catalyst that would you know, elicit some profit taking. Nothing, Dale. It is a resilient Teflon market, and it just continues to climb the wall of worry. And you know, it doesn't seem like there's anything that's going to take it down.
Yeah, and bond bulls got crushed. We're almost back to this breakout around 93.5. You know, we're a bad day or so away from it. Have you know, from what you're seeing and what you're hearing, has negativity picked up in longer duration of the bond market in the last week or so? I mean, it's only bounce, this little thing here, and maybe even after you give me an answer, maybe I'll just hand the screen over to Grega, or you, Blake. But I think there's got to be I'm not sure this was all of it, and this could end up being something to consider coming up here.
Yeah, well, one of the things, I mean, you know, you see the bond markets coming off as you got the TLT, and I've been looking at the ZNs. I mean, yields are going up, and you know, this is where, you know, people start going, well, shoot, you know, how many rate cuts are actually coming our way? I know Ryan, what by your estimations and what you've seen, what's the Fed on track to do here for the remainder of the year?
225s.
225s. How about if inflation comes in, if CPI comes in hot? And Dale, I'll take over for a little bit, and then we'll cover what.
I mean, isn't it classic that the bonds really did top? That candle I was pointing at was the half-point cut, and that triggered this sell-off in bonds.
Yeah, I mean,
counterintuitive.
It is counterintuitive, and now we have you know, two 225s being priced in for the remainder of the year. But what happens if CPI comes in firm? You know, I mean, what happens there, Ryan?
The market's obviously going to probably wash out one of those 25s ahead of the number, and the Powell's got a job on his hands, because it depends how hot it is. You know, if both go up, the core and headline CPI above the last month's reading, then the market is going to ask questions again. But I think until then, you can't really be swayed in what the Fed wants to do. The Fed wants to get rates down, okay, and there's enough weakening in the economy for them to continue to bring rates down. They're not going to react to one data point. The market will, as we know. The pendulum will swing, and we'll probably start pricing in an unchanged for the next meeting. But I think that unless the data and then another NFP is really hot, then they're going to cut twice, and the market starts getting all hawkish. It's going to be wrong.
Right. Yeah. It's really a nice pendulum swing, and we saw a similar pendulum swing at the beginning of this year as well. The only thing that we've got different right now is that we actually have a Fed that has acted at least once in 2024. Hey, real quick before I want to come back to you guys. I want to talk a little bit about the yen. I want to talk a little bit more about China. But I do, since Grega is here, we're going to leverage his time a little bit. And as Dale pointed out, and he wanted to ask you, Grega, and I'm gonna ask you real quick too. What are you thinking about, like, yields right now and the bond market here? I'm going to pull up your charts on the 10-year. But what are you thinking right now?
Actually, just let open yields. You have the yields if you click right.
Yep, right here.
Okay, so basically, if we start breaking this 4.2%, I just think that there will be much more upside on the US yield, and we could basically be bottoming, especially if inflation would really come out strong. Then on the top of that, I think that there could be some risk of environment. China has came to the downside. So since you mentioned yen pairs, I just think that those yen pairs are really at some very important reversals. If you look at Aussie yen, I just think that this one, because of a pretty strong sell-off of the Aussie, I just think that this one is actually at the perfect resistance already selling off. So I'm thinking that we will see more downside, and the Japanese yen could actually be doing pretty well if we see a risk of environment. Also, when China was up last week, at some point, US shares were not been able to follow that market. Firstly, they were, but to the lower degree, but then completely moved sideways. So now when China could possibly be looking for a deeper pullback, I think that there is a risk that shares and globally will also see more weakness.
Yeah, I mean that's a hell of a reversal. No new China stimulus measures, and I don't know what the market's thinking that you're just going to get.
Blake. I do.
You think that they're going to get, China's going to continue to offer stimulus, more stimulus?
No, Tepper was one was bullish down there, and the Bears beat Carolina, so he's probably liquidating his position to try and buy some players so they could do better than 1-3 or 1-4, whatever they are. No team has made the Bears look like a championship contender in many years, and thank you, Carolina. So I think that's my explanation.
All right, well, we'll take that one. Real quick, we had this move in China overnight. I was not surprised that we got a reversal, but what I'm more surprised is U.S. equities held up very well, and what my last comment was before I left yesterday afternoon to the gym, I was like, I think U.S. bulls are just kind of hoping that Asian equities are going to hold up, and we're going to see some follow through in China to keep the bullish theme alive. And when China reversed, I kind of woke up this morning thinking that U.S. equities might actually be under a little bit of pressure following China, but that hasn't been the case. And if you look at the S&P looks really good. You look at the German DAX has pivoted right where we're supposed to. You know, we came right back down to the breakout point, and we held it. Like I said, equities around the globe look pretty decent. And so, with what Grega said, as far as the recovery we've seen in the yen pairs, I want to show you a chart in here. If you go into the ForexAnalytix chat room, and you go just before I came in this morning, Gavin, he posted about the dollar yen. And the one thing that happened with the dollar yen is the dollar yen actually, came down to previous resistance, which is acting as current support. I closed out only a quarter of my dollar yen last night. And if you guys don't know where, where I'm at for positioning wise, if you go over to the trades room, and if you were in the chat room last night, and I said I took some of the dollar yen off at 146, 148.88. Yeah, it was where I pulled some of mine off last night for 128 pips off of my average. But what it ended up doing is coming all the way down and spiking down to the 35 level. It came down much more after I got out of some. Here, it came down and bounced right where it's supposed to. And the reason why I think now this level is really important and is because this is basically where the dollar yen turns bearish. So if you guys want to just jot that number down,
take a screenshot.
Yeah, it's basically 147.35. If that level breaks, I would not want to be short yen or short yen in any way, shape, or form. Period. End of story. And what's gonna do that, in my opinion, would be data, or unless maybe we get some some BOJ rhetoric, more talk, more rhetoric about swift yen weakness and yen moves. If we get that maybe over the next couple of days, I doubt that's going to be the case. I think it's going to be more U.S. data related that would push us down there. But real quick, I wanted to ask Ryan if you had any thoughts about this yen as we wrap things up today. So
yeah, I'm in the same boat. I was short from up top, but I got some out 147.74. I actually had my eyes off the screen when it made that move down to the 34 level. My pencils are a bit thinner than yours. My level, as it was on the way up, was 147, 2025. That's my key point on the way down. So it's you've got quite a thick paintbrush on yours. So yeah, it's only 10 pips less than yours, but it's there or thereabouts.
It's real important.
It's historical. This 147 level, it goes back years. Okay, it's a big level. So you can't dismiss it in any way, shape, or form. I mean, decades it goes back. And when we haven't been there for a while, when we've moved away and we come back, it's going to have a saying thing. So yeah, I think you're right. It's a pivot level. If we're back below 147, most definitely, then things are looking bearish again.
All right, very good. And let's get Kman. What are your thoughts as far as that level goes, and what could be the catalyst that drives us below it if we're going to go below it? What do you think?
That's what I said earlier. Weak CPI in the US could put it below and hold it below. Yen's made its biggest moves outside of interventions, obviously, but made its biggest move actually on US data compared to anything else. So I think that's going to be the catalyst to drive it down there. And yeah, it's a pretty interesting level. It should have gone like just a couple of pips below where it stopped today. Unfortunately, it didn't. It didn't get me in. But I'm a little, I'm from the chat room. I'm a little long actually. I think we are barring low inflation, but we know where the stop is, so that's pretty clear. We may be in for a test of that 50% there around 150.80 at some point.
All right, very good. Thank you, Kman. Hey, we're going to be bringing in, and Dale gets to interview one of my favorite people in the currency market, which is Mark Chandler. So make sure you guys stick around. He's one of the best in my opinion, and I'm glad to have him here. But before he comes on, I do want to mention just a few things. You know, as far as you know where we're at in the markets, I still want to point out that the dollar Mexican peso is holding above 19, and this is where I start to, you know, I get out of any longs that I have or short Mexican pesos. But we do have tomorrow. Let me make sure I've got I got that. Yeah, we have actually Mexican CPI coming out tomorrow. So maybe that might be a catalyst that drives us away from here. And wasn't there a headline from Mexico, Kman? You put that in the ForexAnalytix chat room, right?
Yeah, but it's just more of a comment than a headline, really, that they want to look for ways to diversify from Chinese imports. The problem with that is that they rely on they rely on them quite a lot. But as I said, yeah, Trump yesterday or over the weekend said that he wanted to slap 200% tariffs on goods imported via and cars imported via Mexico. So no, but I think you're right. I mean, 19 is relatively crucial on the dollar mexa.
Yeah, I think so too. And here's the other thing I wanted to point out, and I'm so irritated with myself not getting long the dollar Swiss. We've been looking at this range forever. You know, it was 84 to 85.50, you know, 84 cents to 85.50. Yesterday we backed up right to the breakout point, and I sat there and looked at it and said, I need to be long dollar Swiss. And it just sat there. It sat there literally for hours, and it looked like it was coming down because it was like trading into the high 30s. You know, it's like 85.30 something. And I'm like, and I thought to myself, I reaffirmed in my own mind, oh, Blake, great idea. Glad you didn't buy it. You didn't want to take on that risk with everything that's happening in the Middle East. And of course, I get up this morning and the damn thing's like, you know, jacked up about 30 pips, and I was going to get aggressively long yesterday, and of course I didn't. And sometimes, you know, as traders, we you know, these trades, you know, they're good setups, you don't take advantage of them. And this is a perfect example of me not taking advantage of something I knew would be, that was like a so correct in my mind trade that I needed to take, and I didn't take it. But I just want to show you how well that's being respected. Like another big support that we saw in the dollar yen, knowing that 147 and 147.35, 147.25 that, you know, Ryan's looking at is really key. Well, guess what? The dollar Swiss at this 85, you know, 30 level, 40 level, it's also very critical for the bulls moving forward. Guys, in case you missed it, sorry, excuse me, our 8-year anniversary sale is over. And so if you missed the prices, sorry, you're going to have to wait at least a few months before we can bring that pricing back. But the good news is now you can take a trial of ForexAnalytix. It's $1 for 10 days. So make sure you download the mobile app, take a trial, come jump in the chat room for 10 days with Ryan, Kman, myself, and a lot of other traders, and get the experience and enjoy it and enjoy your time there. So try us out. Dale, have a great interview with Mark Chandler. I'm so happy to have you back. We've missed you. I know all the traders here have missed you, so it's really nice, and I'm glad you had one of the best weeks of your life. You must have had, I mean, to have the one of the best weeks of your life, that's pretty damn cool. So I'm glad you made the trip.
Good, filled with the key word LOVE. And you know, I really have to respect traders that golf, because trading was agitating enough and aggravating enough to me to then, after the market close, go and aggravate myself on a golf course. So I really, that's why I gave it up. I said, you know what, this is like trading. You know, everything goes great, sugar to, you know, the other. So it's great to be back. You know, guys, that a lot of people when they go on vacation, when they're on their way home, they're like lamenting, oh, back to the salt mill, this and that. So, you know, if you are looking forward to coming home because of your career and your profession, you're very fortunate that you landed in that position. And I'm glad to be back too, Blake. You know, it's in my blood, and you guys are great. And so keep that in mind, that a good coach can change the game, but a great coach can change a life. And you have an opportunity to learn from these guys. And you know what? They don't charge a lot. And the other reason is teachers don't care about income, they care about outcomes. Okay. So that's what these coaches will do for you. So sign up and get better. And who better than Mark Chandler for me to come back and be in the chair for an interview? Let's see if I still have my chops. And talking to Mark. Mark, great to have you here. Really interesting times we're in. I think
I think
have.
that's a curse, Dale. Interesting times. You know, maybe about your golf game. I think maybe there's something in common with trading, and that is that macro guys like myself is sort of like the driving for show, and the real money is really made in golf, like in trading, is really in the short run, and that's right. They say drive for show, putt for dough, and that putting means risk management. It means knowing about managing a winning position, but also managing a losing position. It's honoring stops. It's discipline. And so I think there's a lot in common. Even though I don't really golf, I can't say I golf well, but I kind of find that there's two people that golf: people who play golf and people who golf. And I'm a player.
All right, I'm glad you know that that was a great metaphor for what it's like. It's a short game. Yeah, it's not if you know can hit a ball 300 yards off the tee. You could do that and end up with an 11. I've done it. So anyway, great analogy. So let me ask you, Mark. I mean, you know, I was away, but I was here for the Fed cut, and then I saw the numbers Friday. You know, even when you're on vacation, you still take a peek, right? You're not uh, maybe 100 times a day. Anyway, so what do you make out of the half a point cut and then the employment numbers that we had on Friday?
Sure. Yeah, when it comes to the 50 basis point rate cut, I think that both Fed Chair Powell and Governor Waller both cited the CPI that came out during the quiet period. And many people, even economists after the CPI, were looking for 25 basis points. But then it appears, and of course there's no smoking gun here, but it appears that a Federal Reserve official, perhaps Powell himself, got a story planted in the press, Wall Street Journal, the FT, that played up the risk of a 50 basis point cut. For people who are close observers of the market, this isn't the first time such a story had been planted to try to influence the market. And I think that the jobs data on Friday, I think that, you know, the market was, you know, in September, the Fed said, we're going to cut rates 50 basis points in Q4. The market said, no, you're not. You're going to cut rates 75 basis points. So, of course, we get this overreaction to the jobs data. It was a 1 month number, and it's terribly skewed. And here's one thing that maybe some of you might not be fully aware of, and that is, as you know, there's two surveys: an establishment survey, which gets us a non-farm payroll number, and a household survey that gets us the unemployment rate. We are having a very low corporate participation rate in these surveys, which is part of the reason why we get these substantial, at least statistically substantial, downward revisions or revisions really to the data. Last time we saw upward revisions. So, you know, I think the data has been skewed by this, and that accounts for these revisions. And so I think that the market is a dramatic response to it, but let's not lose sight of the underlying picture. When it comes to inflation, the Fed says there's one number that captures its mandate, and that's the PCE deflator. But when it comes to the jobs market, there's many different indicators, and I think that on balance, the indicators suggest that the labor market is still slowing. And so I would take, I think that the market's reaction now, driving up interest rates, driving the dollar sharply higher, this is largely a function of market positioning. And it'll take some time to absorb it, but I think that we're still on track for 50 basis points in Q4 for the Fed to cut. And I think we're still in store for a soft CPI number tomorrow, especially the headline number.
Okay, interesting take. On my way back on the plane, this young lady sitting next to me who went to Stanford and has been applying for a lot of jobs. She says the job postings may not be real because she could send out, 50 resumes and get, one or two, maybe just responses, get back to us in 90 days, but no hires. So I don't know why employers would keep jobs posted and then not hire people. Can you explain that?
Yeah, I think that there's still a sense of hoarding. I think that many businesses experienced a shortage of labor, and thinking that if the Federal Reserve is going to cut rates the 100 basis points next year, like they said, then maybe this is just a short-term slowing of the economy, which we still haven't had much of a substantial slowdown. And so I think that it's really a cautionary element for businesses hoarding labor, that is to keep the labor rolls higher than perhaps the economy justifies for fear of the replacement, the hardship and the cost of replacing. So I think this is part of the post-COVID, post-supply side
PSTD. They still have PTSD about finding workers.
Yeah, I think so. And I think that, what we saw with the jobs data last week was a lot of hiring, the bulk of the hiring coming from restaurants, bars, hospitality industry. And I think that's a sign of expected consumption as we head into the holidays. And remember, we had this, it was only a 3-day dock workers strike, but it looked like it could have lasted longer. And so it seems to me that also is an economic factor. Companies building up inventories, not wanting to be caught short for Q4 and the holiday season. And I think the labor market just fits into that as well.
Okay, buddy, let's get to your wheelhouse. And not that we weren't, but
you talking about
you came into.
You talking about the levy that the Chinese are going to levy against European brandy?
I didn't know that, but is that the reason for a 200 pip decline in Euro USD? And is this just corrective action here, Mark, or is there something else going on now that after we cleaned out all the dollar bears, that came late to the party? Is it break to buy, or should we be cautious with what the dollar's doing based on the confusion of the employment report against Fed policy? And where's your head at on the dollar? Are we do we have more to go on the upside in the dollar? And
I think we have
more.
Yeah.
Okay.
I'm thinking that we have a little bit more upside to go in the dollar. Maybe you could go back to that euro chart. What I'm looking at that euro chart is that double top, at 112. Yeah. And, one of the reasons why I felt confident that 112 area is going to hold is because one of the indicators that I look at, that this sounds kind of old school, but I'm looking at the US-German 2-year interest rate differential. And we peaked back in April over 200 basis points. And by the middle of September, we had fallen to about 135 basis points. And that's what accounts, I think, for the dollar rally this summer. However, as the interest rates as the US premium began rising, the euro was still like bouncing around that 112 area. But I felt confident it was going to hold. And that 2-year interest rate differential, which bottomed near 135, is now near 175. And when I look at this when I look at the euro, everybody sees the same thing, I'm sure, that I do, a double top with a neckline at 110. If the top of that measuring objective is 108. And I kind of think that 108 is a bit far, but I'm thinking that we could get down to maybe it's 108.75, 109 area. I see you have that as a line on your chart as well. And I sort of like that general, moving averages. And
200
retracements. Yeah, and so I'm thinking that that this euphoria about the jobs data, if they take a while for it to wear off, and it might take most of the remainder of the month. But I am thinking that that the dollar's up move is just a correction, that the underlying trend of the dollar is driven by short-term U.S. interest rates and its Fed policy for the most part. And so I'm thinking that this is just a correction to the summer rally in the euro and the summer setback in the dollar. And I look for the dollar to weaken off, but I think it's got a little bit more strength here. I don't think there's been a full capitulation yet.
Okay, that's interesting because we have things like Aussie. It looks vulnerable, and I'm wondering if what's going on in perhaps Ukraine having any impact here, and are people starting to think about what's going to happen here in the U.S. in the less than a month, with one of the candidates already talking down the dollar. They want a weaker dollar, former President Trump and J.D. Vance, and try and turn this economy into more of an export economy. And you brought up the tariffs, I believe, on brandy. Do you think that's going to be part of their economic plan, is make the dollar the sacrificial lamb?
Well, out of all the things that move the foreign exchange market, I don't think the wishes of policymakers are very high on that list.
Yeah.
I think that the reason that
go ahead.
I'm sorry?
Go ahead.
Yeah, I just think that that when I try to understand what's moving the dollar, I think there's a tendency for people just to be to look at the new shiny object, whatever that shiny object is, which really prevents like a very rigorous, systematic approach to the foreign exchange market. I think so in the back of my mind, I have short-term drivers like market positioning, news, that sort of thing. Medium term, I might have Federal Reserve policy. I might have the fiscal policy, that policy mix. And in the long term, I'd have things like a GDP per capita. And so I think that the elections in the U.S., as close as it seems to be with a month left, I don't think it's really become a factor in the market, because I think we can explain the price movement without citing it. So I think that to watch what you think are the drivers and watch those, and when they don't do a job explaining the price action, then you've got to go someplace else. But I don't see the election being a big factor yet. I don't see Ukraine being a factor. I see it's really kind of old-fashioned, but I see the U.S. interest rates, market positioning being the near-term drivers.
Okay, so
maybe about a word about the Aussie. I think on the way up, China was closed; it just reopened today, and people took it. And I think that among the G10 currencies, the Aussie is sort of the closest thing to a China play for a lot of people. And I think people were right beginning to take profits on the Aussie. The Australian Central Bank, the minutes came out today from the past meeting, and again, the RBA, like the Central Bank of Norway, are the least likely to cut interest rates this year. It hasn't really helped the Aussie in the past week or so. I'm concerned that the Aussie has a bit more room to go. We tested that 67-cent level today. I see that, where you have your line too, that's where I would have it, that moving average around 66.50, maybe a little bit below that. I think that's I think that's the risk. And that's why I think the momentum indicators are still falling.
Yeah.
So there might, so I think it's dangerous to try to try to catch this falling knife quite yet. For my intestinal fortitude, I'm waiting to see some sign of a bottom, and I'm not sure it's there yet.
Okay. Well, why don't we move to the yen, Mark, because this level that we held, really have to break out the telescope, and we're talking about it here in F.A.C.E, was this 142 level. I mean, it can't be any more obvious. Let me go to the weekly. It shows up better there. But look at this. I mean, 140, I meant 140, 140. So we got this bounce off 140, and we've had a nice rally with yields starting to take back some of their optimism about rate cuts. Does this still look like an important top? And is there a pretty good selling opportunity setting up here between here and 150? Because if we take out 140, that's going to measure pretty big. Actually, it's going to measure 120. Dare I say it?
Wow, yeah. I don't I still think that, because I think that US yields might not have peaked yet. I think that there's scope to 150, 151.
Yeah.
I do think that important top's in place, partly because I think that an important top in US interest rates are in place. And
Got you.
this is the thing. I mean, when I say about keeping an eye on what you think are the drivers, I try to run these correlations between the yen and other currencies, but seeing what moves where the strong correlations are. And the strongest with the yen is still the U.S. 10-year yield, not the 10-year interest rate differential with Japan. Oftentimes, U.S. Treasury yields are more correlated to the yen than the spread. But I think that
Yeah, very similar charts. I mean, they're almost like Siamese twins lately. They're joined at the hip. The moves may be different in magnitude, but the patterns seem very similar.
Yeah, what we're talking about is the correlation between so we're looking at the correlation of the change in the yen and the change in the U.S. 10-year yield, and that's above 0.65, which is really the upper end of where those correlations go. And I know people might be thinking I've got like, did I see what happened yesterday when yields rose, but dollar yen came off? And when we talk about a correlation of 0.6 and 0.7, what that means is that say in a 2-week period, 10 trading sessions, there might be 2 or 3 that the correlations aren't, that don't work. That is, higher yields don't translate to a weaker yen. But over time, these correlations tend to be fairly reliable, fairly stable. And so I think that if for me, I take my cues from the yen, from looking at the U.S. 10-year yield. It doesn't work every day. Dollar yen is a little bit softer today, so are U.S. yields. It tends to work most times.
Yeah, and it seems like the beta is much higher in USD yen than the 10-year yield, but the 10-year yield hasn't exactly been quiet. Do you see the irony that yields troughed on the Fed cut of a 0.5 point? That's when the bonds started selling off on that cut. And you would think, and I think I'm hearing this from you, that this rally in yields, just like the rally in yen, is counter trend. So that must mean there might be a pretty good buying opportunity in bonds. Or are you afraid of longer duration?
No, I think, a funny story. I've lived in Manhattan for over a decade. I sold my apartment in Lower Manhattan in May, and I have just put what equity I had into medium and long-term Treasury ETFs. I think it's a good place, a safe place. Back in May, yields are of course much higher, so capturing capital gains as I wait to look for my next purchase. So yeah, I'm not afraid of the duration here. I do think that the challenge really is that it's about market positioning, and yields might have to go up a bit further first. I'm looking at the 10-year, maybe it's up to 410, 412. But I think that over time, as the U.S. economy slows, interest rates will fall.
How about a hot number Thursday to fade?
Yeah, I don't know. The strange thing to me is CPI is that very rarely surprises. And to the extent it surprises, it tends to be from a rounding adjustment, a rounding error. So I still look for soft CPI on the headline, perhaps even maybe 0.1% rise on the month, core rate a bit stickier. But the Fed has told us that their focus has shifted. They're now confident that inflation is going to be falling back towards its target, and that the focus is really on the labor market. And I think while the market is very impressed by the jobs data last week, I'm not convinced that the Federal Reserve really is. I think the Federal Reserve is going to say it's within what they had expected. That is maybe a little bit stronger, but it's generally in line with what they expected. And so I think that they will not change their view. And I think that they'll still cut in November, shortly after the election, and setting us up for a December Christmas cut as well.
All right, Mark. I'm up to speed. after talking to you. Thanks for your giving spirit all these years, Mark. And I strongly encourage people to go to your website to sign up, to follow Mark's work and your intelligence gathering. And Mark has a special talent for blending the technicals with what's happening fundamentally. And a lot of people are one or the other. He's very holistic in his approach to the markets. And Mark, I respect your work, and I like you. And it's always great to talk to you. I hope you have a great fourth quarter.
Thanks, Dale. I appreciate the support. I thank ForexAnalytix for posting the commentary, making it available to more people. Appreciate it. So good luck to everybody.
We're fans. We're all fans here, Mark. I was wondering if you could maybe send me a poster of yourself for Hanukkah.
There you go.
Autographed. Anyway, all right. I've heard that before, buddy. Mark Chandler, everybody. At the minimum, follow him on X at Mark Making Sense. And, you're not going to be, you're going to be more well-rounded knowing how Mark looks at things. And he doesn't get, how some people are sensationalists. Mark can break it down to where, all these narratives you're hearing about that maybe you should consider the way he's seeing things. We only have two eyes. So, use the eyes of Mark Chandler and his views of the market for you to get better. Thank you, my trading warrior brother. Really appreciate it.
Thank you. Good luck.
All right. Mark Chandler, everybody. You could join the team in 17 minutes on the morning edge. And if you can't, just take that trial and you can check it out. You need to be in there. This fall is going to be something where, especially after the election. I don't think, just like the summer wasn't slow, how we slow down after Thanksgiving and it's almost like year is over. Not this year. Okay. So get ready. That's a wrap. Don't just count your pips, count your blessings. Good to be back, and thank everyone for welcoming me back. And I'll see you tomorrow. Good hunting, everyone. Don't just count your pips, count your blessings. Adios. Thank you, guys. Thank you, Mark Chandler. See you, everyone. Get into the room.